Inflation continues to be the name of the game. After an increase in inflation through 2022, the fallback towards the Reserve Bank's target remained the central data point of 2023 and into 2024. The Reserve Bank is very sensitive towards volatility in inflation prints, which had been falling at an accelerating rate through 2023, until late October, when September quarter inflation numbers were released. These showed that inflation had increased by 1.2% quarter on quarter, up from the previous quarter's reading of 0.8%. Remembering that the Reserve Bank is doing all it can to reduce inflation, this number was enough to prompt it into action. And in its meeting the following week, the official cash rate was increased by 25 basis points to 4.35%. In the statement following the release of its November rate increase, the Reserve Bank Governor Bullock noted, "The latest reading on CPI inflation indicates that while goods price inflation has eased further, the prices of many services are continuing to rise briskly." While the central forecast is for CPI inflation to continue to decline, the progress looks to be slower than earlier expected. Let's pause there for a moment. As we're out in the market speaking with investors, it's clear that not everybody sees inflation the same, or indeed explains it the same way. So let's take a moment to explore what it is, what the target is, and what the Reserve Bank is looking for. CPI inflation of between 2 to 3% remains the target for the Reserve Bank. So what is it exactly? CPI, or the Consumer Price Index, measures the rate of change in the prices households experience as they buy goods and services. You may have heard about the basket of goods that it seeks to measure, a folksy metaphor aimed at showing the rate of changes across key household spending items. Under the hood, the basket of goods comprises 87 categories, which fall into 11 broad groups. The Australian Bureau of Statistics calculates the price changes of each and aggregates them to calculate the inflation for the entire basket. Noting the Reserve Bank's remit, maintaining stability of currency, full employment, and economic prosperity and welfare of the Australian people, CPI inflation makes sense as the number, but only if it were that simple. While the Reserve Bank wants CPI inflation to fall, and notes that it is falling, that same statement noted that underlying inflation was higher than expected at the time of the August forecast, including across a broad range of services. So, what's underlying inflation? Underlying inflation, also called trim mean inflation, is the CPI inflation number adjusted to exclude items which have had a price change in a period of a large magnitude. It may be due to seasonal price changes or some other temporary conditions. It may be, say, the cost of education, which changes once per year, or when a weather event has had a disproportionate impact on the price of an individual item of food. By removing the seasonality of the reading, you get a better sense of the direction of prices. Right now, both CPI and underlying inflation remain elevated. In addition to the quarterly figures the Australian Bureau of Statistics released on inflation that we all rely on, they also release a monthly figure which is a limited sample but shows the continuity in outcomes. Both are showing inflation is on the way down, but not fast enough for the Reserve Bank to avoid its latest rate increase. And if you exclude the volatile items, it's still high, and that's an issue. But it's also hard to address. Consider that the items in the September quarter, the rate of growth in prices of all grocery products fell. In the same period in the services sector, insurance, dental, and the rental prices all rose. This second lot of items are somewhat more inelastic in their demand. You have to pay the price of getting them done. These are items which are included in calculating the underlying levels of inflation. And this is what the Reserve Bank and others mean when they say inflation is becoming more broad-based. It's prevalent in items which do not typically have seasonality. So the Reserve Bank is walking a tightrope. The rate of growth in consumer discretionary items is falling, as they have been for some time. But those non-discretionary items, not so. The utility of further rate rises becomes difficult to square, but it doesn't stop there. In forecasting inflation, the Reserve Bank considers employment, wage growth, and productivity. The effects of prolonged low unemployment sees firm wages growth. However, the low cost of funds over the last decade has seen no real investment in productivity growth. Now, wage rises above productivity gains are potential fuel for inflation, because if the wage someone's getting paid outpaces the general output that person is generating, then you're effectively putting more cash into the economy. So it's all very complex. As is being widely discussed, higher interest rates are seeing some younger groups doing it tough with increased mortgage repayments and obvious cost of living pressures. Income investors are seeing yields increase, but are having to spend more themselves just to maintain their lifestyle, which is ultimately inflationary. With inflation falling from its cyclical peaks in a global environment of uncertainty, some volatility in the quarterly inflation numbers is inevitable. The market sees us as probably at peak rates now, with the small possibility of one final increase through the first half of 2024. And since the Reserve Bank doesn't meet in January, there'll be some time to review December's quarterly inflation data to get a better understanding of whether inflation, headline or underlying, is returning to target fast enough. Thank you for watching.